Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. If you have been following equities, it's not just the Indian equities which fell substantially. Markets across has had a downside action lately, and just when S&P 500 was about to hit its high, markets took a turn down. On the other hand, data has been slow, but the UK inflation fell much more than expected on all fronts. Data otherwise has been slow, and as we look forward to the US GDP and initial claims data, let's hear from JK his thoughts on the markets.
Good morning, Swaraj. Let's start with Indian market, where after a few days of larger moves, rupees back to narrow, stable ranges. Most of the trades happened between 83.15 and 83.20, with the year-end factor keeping even major currencies somewhat subdued. But there was a big sell-off in Indian equities yesterday that was long overdue, both on technical and valuation basis. Benchmark index made a new all-time high and fell below previous day's low, which in technical terms is read as a key day reversal. This means stocks can be under selling pressure for some more time, though not necessarily a trend reversal. Overnight fall in other major indices globally also adds to some downside momentum, but with no negative factor actually driving these, excepting a positioning and year-end profit-taking motive. This is unlikely to affect a dollar trend in INR much, as the FI activity has been rather muted, and year-end profit-taking action should not be influencing the forex much. I don't expect trading in the run-up to December end to be driven by, I do expect trading to be driven by normal flows and with any excess on either side being absorbed by central bank. Now, one significant number yesterday, as you mentioned, was the UK monthly inflation number, and that plunged in November to its lowest rate in more than 2 years at 3.9%. And the government also reported CPI inflation was at 3.9% year on year from 4.6% in October. The number of banks who have been pricing or interest rate cuts front-loaded as far as other central banks are concerned, but Bank of England was not so much in the front line, but now they are also getting closer to a rate cut being priced in for May. That's a big change that this CPI number has brought up in the market's expectation. But if you see the data from US also, they were quite strong. Consumer confidence soared to 110.7 from 101 last month. Existing home sales picked up in November from minus 0.4% to 0.8%. One factor behind improved sales, as well as even the consumer confidence, is the 30-year mortgage rate, which has broken below 7% now, and now it is at 6.83%. You can recall that it had hit a 23-year high of 7.9% exactly a year ago. So that change actually has led to some improvement in the existing sales as well as consumer confidence. Consumer confidence itself was at a 5-month high. Americans growing more optimistic about current and future business conditions, and most people do not actually expect a recession in the economy, at least for next 6 months. That is what the survey is saying. Now, markets have been so thin that even the lower UK CPI was enough to push yields across major countries down. US 10-year hit 3.84%, German 10-year 1.95%, and UK gilts for 10-year 3.53%, and all of them have been cycle lows. Now, market pricing in rate cuts by all the three CBs, rather the central banks, starting at least in May 2024. Neither the large auction of 20-year paper by the US government nor better economic data from US actually held back the bond bulls. On the stocks, it does look as if the global markets took early cue from Indian equities, and the price action in US market was almost similar. The major indices there, particularly the S&P 500, made new cycle high and then saw a sudden slump in the afternoon session. All three major indices were 1.3% to 1.5% below Tuesday's close, and large amount of put options were also traded. Similar action has been seen in global index, which made a new high and slumped 1%. Now it does look like a global profit-taking action on big run-up in the equities. with a lot of good news being priced in, Fed dovish put, as well as the fall in inflation, all these things now quickly priced into the stocks, and now investors are booking some profit ahead of the year-end markets, because I think from next week onward the liquidity even will be much lower, and that could be the reason. So we might well see some follow through in the coming sessions as well. Of course, I'll be watching the stock markets in the coming days and weeks as they look stretched in valuation and or seen overbought as well. Importantly, all good news, as I said earlier, have been priced in. And if we are discounting a 1.5% rate cut from Fed, either there is a huge scope for disappointment, which has been hinted by Fed members very frequently, or you are actually expecting an economic slump, and that will not be good for the market. So either which way, stock markets need to correct from these levels, and even that goes for the dollar as well. Dollar has been on the softer side, ignoring good data from US economy and continued pushback from Fed members and even the ECB members who have been quite vocal yesterday. However, market is not able to push the dollar further down through the supports against the euro. And I am seeing divergences on the daily chart, which to me is a sign that the greenback may post a strong recovery in the days ahead. Maybe it holds off till the end of this month, but I think come New Year, I think based on mellowed down expectation on interest rates, which eventually should occur, as well as the data from US that is ahead, we might see dollar also posting some recovery. In fact, today we have some of the today and tomorrow we have some good important data. GDP final revision or final reading for Q3. Then Philly Fed manufacturing survey, jobless claims all come today. Tomorrow we have the core PCE inflation number. So we have the last couple of days of good economic data to chew on, and perhaps some good action on the dollar as well as the stock market ahead. Yields may just hold off for some more time because of the safe haven and market not relenting on their expectations. But all that should end up with Christmas party beginning Monday and to the year end as well. Thank you.
Thank you, JK. And good amount of profit taking in global equities. As you mentioned, it seems that traders are, getting out before celebrating Christmas. And next week onwards, liquidity will even be lower as Western markets go on their Christmas breaks. Now, UK inflation plunged down to 3.9% from 4.6% in October. And one significant change which has been happening is that earlier rate cut by the BOE was not being priced as early as May. But now, after this data, rate cut for BOE is being priced somewhere around May. When it comes to rupee, we are back to stable ranges, essentially at a lower level though, but we are still moving in 4-5 paisa ranges. Indian equities had a big fall. Again, this was on account of profit taking and positioning. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.